From New York City for our viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, U.S. government shutdown puts economic data on hold, further clouding the Fed's path forward amid this shifting economy. Nevertheless, September credit issuance surges to new highs. We begin with the big issue, and that is a Fed flying blind.
It's a strange no jobs report, Jobs Friday.
This shutdown is compounding an existing problem, which is that our data is being substantially distorted.
I fear that we're in a holding pattern waiting for more data.
It's very difficult to look at the data without having the data.
Some of the other private sources of data will be more important.
The issue there is a lot of that alternative data, it doesn't have a long time series.
We are still in the midst of an environment where there are a number of supply shocks affecting the economy.
This is a unique position where the economy is growing, pretty healthily, and the labor market is kind of this odd one out.
The less data that come out, the less of a reason the Fed would have to deviate from the dot plot.
The focus is beginning to shift away from inflation just at a time when the risks to inflation remain to the upside.
Bonds are not pricing in a big slowdown.
The Fed has a very tough job going into the next couple of months. A lack of data doesn't help it at all.
So this lack of government data is forcing traders to look to alternative data sets, things like RPLS, which estimates that non-farm employment increased more than 60,000 in the month of September. That is more than the average analyst estimate in a Bloomberg survey, which is 53,000, and Bloomberg Economics' own forecast, which is 54,000. Now, earlier this week, ADP reported a drop of 32,000 jobs in the month of September. Despite the risk of more data delays, in a wide-ranging interview, the newly minted Fed governor, Stephen Miran, told Bloomberg that he is not overly concerned.
Access to high-quality data is of utmost importance when making monetary policy decisions. However, it's also the case that we don't make monetary policy decisions every day. Right? The FOMC meets to vote once every 6 weeks or so. Now, I think that's a bit longer than most shutdowns have historically lasted, so I'm hopeful that we'll get the data by the time we actually have to make the decision. I do see part of my job as bringing fresh and out of consensus ideas to what can be, at times a settled way of thinking. I have no trouble saying my view, even when it's wildly out of consensus. And, speaking my mind, as long as I believe what I'm saying, I have no problem sort of speaking my mind. My dots for next year and the year after are not so dissimilar from the rest of the committee. All that's different is the fact that I want to get there a little bit faster.
So let's dig into all of this with Vishy Tirupattur. He is Chief Fixed Income Strategist and Director of Quantitative Research at Morgan Stanley, and Jamie Patton, Co-Head of Global Rates at TCW. So the absence of data, which we just heard about, due to the government shutdown, really highlights the policy risks and uncertainty facing investors. Yet stocks, you look at, they're at record highs, credit spreads are super tight, and fiscal concerns don't seem to be weighing on the bond market. Jamie, let me start with you. Is the market narrative turning more positive, or is it turning more negative right now?
You bring up an interesting paradox, which we're seeing in the market that's both surprising and concerning to us, where you've never been paid less to take risk, whether you measure it by equities making all-time highs, investment grade credit at 28-year tights, the dollar is approaching its low since 2022. You're not even getting paid to take risk by moving out the yield curve. 2s10s is less than its historical average. Yet at the same exact time, there's an incredible amount of negative market commentary that's only building. So whether that is policy uncertainty leading to consumer and business confidence going lower, which could negatively impact consumption and CapEx spending. You have tariff costs, which on the margin could compress corporate margins. It could cause corporations to increase unemployment. Prices could go higher, which could hurt consumption. You have a labor market that was already weakening. And then you have fiscal concerns, and not just in the US, but globally, the UK, Japan. So we see this kind of situation where it makes us a little bit nervous that you're not getting paid to take the risks that are out there.
What's your take, Vishy?
So I think clearly it's not helpful that we don't have the gold standard data that we would like to have. But that said, I think the clearly what we have heard from the Fed in the last meeting and the speeches we heard from Jackson Hole is that the weight on the weakness of the labor market has clearly shifted. So we think that notwithstanding this data point, whether we don't know whether we're going to get the data before the next meeting or not, we think the die has been cast for the next few rate cuts. So we continue to expect that we will get an October rate cut, a December rate cut, and a January rate cut, and expect a pausing after that. And then maybe followed with an April and July rate cuts. So that's our thinking. But from a credit perspective that Jamie brought about, I think while it is true that there are some stories, my point is that the starting point of credit fundamentals is actually in a very good place.
A lot of people come back to that, but I go back to the idea that we are operating with some darkness here because we don't have any data. Austin Goolsbee, the Chicago Fed president, says we're just not getting our usual supply of information. He considers the BLS job data to be the absolutely best data source on jobs and statistics in the entire world. To your point, Vishy, if we aren't going to have those, it's problematic. Jamie, we know that a government shutdown results in lost productivity and economic activity as well, not just the lack of data. If this is something that we're losing, is it just delayed and we'll make it up later on? Or is this something that we'll kind of just lose forever? We can't make up some of the lost productivity.
Consensus in the marketplace is that what we lose from Q4 we'll get right back in Q1. We see some risks to that view, specifically in that this shutdown is very different than historical shutdowns. It's hard to find an analogous one when you look back in history. Number one, the administration has a lot of flexibility to do whatever they want during the shutdown. For example, you're hearing the administration agitate for job cuts instead of furloughs. That's a very different situation where if you have a job cut, not only does that feed into the unemployment rate and the household survey, but you're also going to see it in the establishment survey. In historical shutdowns, the establishment survey was really unaffected. That's where the employers get asked, how many employees do you have? The household survey, you would see the unemployment tick up a little bit, 0.1%, 0.2%, but then it would come right back down as the furloughed workers go back to work. If the workers are cut instead of furloughed, that's a very different situation as well. So it's not as obvious to us that the market should just ignore the government shutdown when pricing risks.
Understood. And of course, you have the job side of the equation. Then you also have inflation. Through this summer, Vishy, everyone was waiting for inflation to pick up in the second half, either as a one-time adjustment or something more persistent. We're now in the fourth quarter, and it feels like we are still waiting. Has the market maybe gotten it wrong? Maybe inflation doesn't pick up further, but instead just stays at these levels above 2%?
So we think a little bit of both of that thing to be true. We think that what we have seen so far is that the companies are absorbing more of the incremental cost, has not been passed on, but that is simply not going to last for very long. So we think that the inflation showing up is still ahead of us. We don't think that we are going to see inflation dropping off here. We think that the inflation will stay sticky at an elevated level for some time to come.
Right, but if labor continues to deteriorate, the labor market that is, rate cuts are certainly in the offing. Lori Logan, the president, the regional Fed president, has been making waves, right, with her suggestion that the Fed replaces its benchmark rate with the TGCR, the Tri-Party General Collateral Rate. So goodbye, federal funds rate. Hello, TGCR. Jamie, I know that you agree with this idea, and our roundtable from last week was on board with it too. How do you think a TGCR as the new benchmark rate would influence the shape of the yield curve?
I don't think it should really change anything out the curve. I think it's just a better benchmark for our Fed to use. The Fed effective rate is a very strange market where really that entire market is made up of home loan banks lending to foreign banks. And foreign banks can arbitrage in that market where they pay Fed funds, which is lower than what they can receive by putting that same money they just borrowed from the home loan banks at the Federal Reserve. So today, the difference is 409 versus 415. So they can get 6 free basis points. And that's kind of the whole market. You don't even see U.S. banks doing the same thing because U.S. banks have capital charges that eat away at the 6 basis points. So it's a tiny market. It's 70 to 100 billion per day compared to the rates that Lori Logan is talking about, which are 20 to 30 times more volume. It's a huge market. It's a real rate that market participants are paying and receiving as compared to Fed effective, which is just kind of this rate that's arbitraged. I would actually compare it to a version of the LIBOR market where it's not a real market that's trading all the time. And we all know what happened to LIBOR.
Vishy, what's your take?
Yeah, I don't have a big disagreement with what Jamie just said. I think that it will take time for this change to materialize, and we don't expect a big effect of this on the shape of the yield curve. And it's clear that this is clearly a much more actively traded market. So I don't have a big pushback on this topic.
All right, thank you so much to both of you. Jamie Patton of TCW and Vishy Tirupattur of Morgan Stanley. We've got more coming up on Real Yield because next up is the auction block. September sales absolutely sizzled. High grade with more than $207 billion of issuance, ranking 5th all-time for monthly volume. We are going to talk credit next on Real Yield here on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the auction block, where September records for issuance were shattered across credit spectrums. In U.S. high grade, the month closed with more than $207 billion of issuance, ranking 5th all-time for monthly volume. Sales for the week actually came in well short of forecast, actually the biggest miss since July. The top deals, they included Thermo Scientific and Societe Generale. Meanwhile, in high yield, a remarkable September with $57 billion of new junk bond sales. That marks the 3rd highest monthly total on record and the biggest since 2020. This month's total easily tops any previous September. And let's talk about the leveraged loan launches here in the U.S. It was a record quarter, totaling near $400 billion. September's strong showing followed both July and August posting records, with the former being the busiest month ever. Mark Okada of Sycamore Tree Capital Partners spoke this week with Bloomberg about this surge in credit sales. Take a listen.
So you can see that the market is very active. It's open, but spreads are tight. And there's not a whole lot of risk premium within the market, but there certainly is an appetite for yield product, given the fact that rates are still a bit high. And so I think that's fueling a lot of the interest in the asset class. However, we're at a time when spreads aren't great, pricing is tight. Let's face it, the credit market is being driven by the equity market.
Let's bring in our roundtable on the credit market. Joining us now, Zachary Griffiths, head of U.S. IG and macro strategy at CreditSights, and David Rosenberg, head of liquid performing credit over at Oaktree. So clearly, blockbuster September, blockbuster 3rd quarter as well. All of this supply, and yet spreads, they just keep tightening. Zach, let me start with you. Why do you think that is? What is going on?
Scarlett, it seems like there's just a lot of cash out there that still needs to be put to work, and borrowers are taking advantage of that at very tight spread levels. And I agree that yields are relatively attractive, and that seems to be what's driving demand, what's driving comfort with adding to credit portfolios, even at a time where you're really not being compensated for credit risk. Now, we think fundamentals are in a fine starting point, but markets typically trade on where we're going, not where we are currently. And we do look for signs of weakening ahead. So we are a little less comfortable with the market from a credit spread perspective, but for total return investors, it certainly is attractive.
So, David, let me come to you now. Is this a sign of a potential bubble, given some of the concerns Zach just highlighted?
I don't think it is. I think what we're seeing is a lot of rotation out of equities into credit. And I think the reality is we're seeing a lot of data starting to hint that the economy could be slowing down, and not necessarily heading into a recession. We're just talking about slowing the rate of growth, which for equities is a bit of a problem. When you have a PE multiple on the S&P of 25, you need robust growth just for prices to stay where they are. But in the debt market, we don't need growth. I just need companies to generate enough cash to pay me back. And so it's a much better environment, I think, right now for debt.
You know, you look at what's happening, and you point to the equity market. EA, Electronic Arts, was taken private for $55 billion, marking the biggest LBO of all time, surpassing TXU in 2007 before the great financial crisis. I wonder if that creates uncomfortable parallels. David, what do you think?
I don't think so. I think that the reality is when you think about EA, we've had a lot of conversations, as you can imagine already. And it seems pretty clear to me the market's going to be able to absorb it, despite the size of the deal. There's a lot of demand, and when there's a lot of demand, you can feed that with deals like EA. And so I think right now, with the quality of the market and the yield you can earn, there's going to be paper to buy.
Well, Zach, to your point about how perhaps there are some areas of the economy that are not doing as well, JP Morgan essentially wrote a $20 billion check at a time when a large swath of the economy, the lower income consumer, is clearly struggling. How does JP Morgan spread this debt out? How successful would they be? How much of it would they maybe get stuck with later on?
It's a great question, Scarlett, and I think it gets to this situation where we kind of have a tale of two economies or two markets going on here in the U.S., where you have the higher income, higher wealth households propelling growth, whereas consumers at the lower end are dealing with this issue of higher price levels over time and high borrowing costs. So when we think of a big deal like this making its way through the market, it seems like there is appetite out there as markets are liquid and there is still cash to be put to work. So we're not terribly worried about this specific deal, but when we think about where we're going in the future, it looks like we're going to see more of that weakness in the labor market, and we think that broadens out the problems within the consumer, and that leads to this weakening that I just don't think the market is priced for or as concerned about as it should be at this point.
Well, how about another source of concern, and that would be First Brands, the auto parts company. We're starting to see the damage from the bankruptcy. UBS accounts have about $500 million in exposure. Millennium taking a $100 million charge. I know that there's going to be explanations like, oh, there was fraud there, potentially, yes, but the company's business was also affected by tariffs, so we know its financial problems are not necessarily unique. Howard Marks of Oaktree has said that bad loans are made in good times. David, how many other bad loans potentially are out there waiting to blow up?
I do think this is something that's really a key point that you bring up, Charlotte, which is right now, I like to say we're heading into a credit picker's market. We've gone through a long period where you could buy good credit, you could buy bad credit, and quite frankly, as long as you didn't sell it, the market just kept grinding higher, everything was fine. Right now, we're starting to realize that the idiosyncratic differences between credits are going to matter. If you're good at picking credit, you're going to avoid the First Brands of the world, and you're going to earn your yield, and the yield right now in the mid-sevens for credit is pretty attractive. But if you pick a First Brands or two, you're not going to earn that yield. It's going to look very different. So I do think there's going to be a separation of the herd right now based on who's good at picking credit and who has just been buying whatever they can find.
Zach, what's your take?
I think about your point on bad loans are made during good times. That's kind of our concern, that we're going to see more of this intentional releveraging, have it become pervasive across markets at a time when the economy might be slowing and could end up being the worst time for that type of behavior. And we've benefited over the past couple of years of a general deleveraging across credit, and that does leave us at a sound starting point. But when I think about how little you're being compensated for credit risk, I'd consider just adding to treasuries at these levels as opposed to really digging deeply into, let's say, the investment grade or high yield market at these very tight spreads. And so that's kind of how we're readjusting, how we're communicating to our clients in terms of thinking about the market from where the fundamentals have been to where they're going.
And to your point earlier, David, not just First Brands, but also Tricolor as well. How big an opportunity is this potentially for Oaktree and other distressed investors? Isn't this what your firms have been kind of waiting for? You could pick up stuff really cheap.
I think it's a very big opportunity on the come, which, as Zach pointed out, if you look at the markets as a whole, risk adjusted, you may say, I want to move more towards treasuries, but Oaktree has made a reputation out of keeping our default rates very low. I like to say we're a safe place to invest in risky assets. And if you can keep your default rate low, the yield premium you can pick up going from investment grade to high yield, for example, is quite dramatic. And I think the opportunity continues to grow if we continue to see more problems, and it reminds people that not everything is just going to work out. You have to know what you're doing in the market, and that should cause things to reprice.
Zach, final question to you. What will you be watching out for as we get underway in this fourth quarter?
Right now, we're watching out for this government shutdown, Scarlett, and does that become a prolonged issue? And if so, does it really call into question some of these economic growth concerns that have come up, really driven mostly by the labor market? But even if you look at ISM services released this morning, the headline number came out below all economist estimates. So that's something that I think could finally jar markets just a little bit if it does become this prolonged issue, as you see the administration taking a very aggressive approach to this shutdown and what they're doing from a longer term perspective with headcount and some of these other spending initiatives. So I think that's something in the near term that the market isn't too concerned about now and hasn't been historically, but at this turning point in the economy and with all the uncertainty, that's something to watch out for.
David, are you concerned about the shutdown in a similar way?
Not as much. I think right now we'll see, right? The market certainly isn't. I think if it's resolved in short order, it won't be an issue. If it does become prolonged, as some people think it might, then yes, it'll be a concern. Frankly, right now, I'm more concerned watching the consumer. This is a market that has been propped up by consumer spending and consumers' just unrelenting ability to keep spending money.
Yeah.
And I think that as Zach said, you're starting to see weakness in the low-end consumer. If that starts to spread, that to me would be a bigger concern for credit in general.
All right, David Rosenberg of Oaktree and Zach Griffiths of CreditSights, thank you both so much. Still ahead on Real Yield, the final spread the week ahead with a slew of government data at risk of delay. We've got more coming up. This is Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the final spread. The week ahead coming up. Over the weekend, Japan's ruling Liberal Democratic Party votes on its next leader, and OPEC Plus holds its meeting. On Monday, the Supreme Court begins a new term, and we get earnings from Constellation Brands. Tuesday, Ray Dalio speaks at the Greenwich Economic Forum, and the JP Morgan Techstars Conference begins as well. On Wednesday, Jimmy Kimmel will be speaking at the Bloomberg Screen Time Conference, and we've got the release of the FOMC meeting minutes as well. On Thursday, commentary from Fed Chair Jay Powell, Vice Chair Michelle Bowman, as well as the Treasury Secretary Scott Bessent. All of that due out on Thursday, and it culminates with Fed Speak on Friday. There's also Austin Goolsbee of the Chicago Fed speaking, and the Nobel Peace Prize will be announced as well. We know that there's one person in the White House who's waiting very anxiously for that. And for my final thought, let's take a look at all the data that is at risk if the government shutdown continues. Jobless claims, we've already missed this week's. Next week's is at risk as well. CPI on October 15th, retail sales for the month of September on October 16th, and wholesale inflation, that is PPI, due out on October 16th as well. From New York, that does it for us this week. Same time, same place next week. This was Bloomberg Real Yield. Keep it right here. This is Bloomberg.